What's up, guys? It's Kev. There's a lot of people worried and asking themselves, will there be a recession in 2023? And unfortunately, I don't have great news for you. However, remember that with the relatively short-term pain of recessions is the comparatively long-term gain of being able to invest in some of your favorite companies at record discounts, which we're actually seeing right now. With the recession potentially right around the corner, I wanted to tell you guys how I'm planning to tackle this from an investment perspective. So in this video, I'll give you a brief history of previous recessions, show you the financial and economic indicators to keep a close eye on right now, and provide you with a framework of exactly how to invest during a recession. So let's get started. Fear, uncertainty, and doubt, informally known as FUD, are the words that characterize how most investors feel in a recessionary environment. Because not only are our jobs at risk, but our hard-earned portfolios are as well. For many of you, this might actually be your very first recession, so you might not even know what to expect at all. So let me give you a quick history lesson because that's a really important place to start. Though the 2020 crash was technically a recession, incredibly drastic policy measures and a huge increase in the monetary supply muted the effects of the crash, and we soon saw record returns only months later. Now, I want you to keep in mind, it's actually been 14 years since the last truly significant shock to the economic system, which of course happened in 2008, 2009. We're all familiar with that. So to tie into that, I really want to hammer home exactly how good of a buying opportunity recessions can be. So let me share a story from Warren Buffett, the Oracle of Omaha, to illustrate my point. In 2008, when the market crashed, Buffett essentially rescued the Bank of America and purchased $5 billion worth of preferred shares from the company. Not only did they come with a very juicy 6% interest rate, but they also came with something called warrants, something that's relatively unheard of for large cap stocks, though in my world of small growth companies, it's very common. Now, these warrants allow you to buy shares in the future at a specified price. Very similar to stock options for employees, but these are made for investors. Because of how serious this crisis was, Buffett negotiated unbelievable terms and had a full 10 years where he could exercise these warrants to buy shares in Bank of America for what was the current market price of just $7. Two things I want to hammer home here. First, as I said, warrants pretty much don't exist in the world of large cap stocks, but they're extremely common when investing in private placement financings for small cap companies. The longest term I've ever had on any of my warrants was 5 years, and that was considered incredible. So the fact that Buffett negotiated a full decade is legendary. Now, second, the exercise price of a warrant is almost always above the current market price. But again, Buffett managed to negotiate these warrants being exercisable at the current market price, meaning any move higher, these warrants were instantly in the money. So let's fast forward many years later. Buffett continued buying and buying, and on his initial $12.5 billion investment, he netted just shy of $23 billion, an absolutely unbelievable return. We call him the Oracle for a reason, but remember, he chose to go heavy in a recession. So with that said, I'm going to tell you exactly what I'm looking for an investment-worthy stock in a recession. First, I need you to understand what exactly is a recession. According to the National Bureau of Economic Research, recession is defined as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. A little more loosely, it's defined as 2 quarters of negative GDP growth. Now, as of right now, we are currently not in a recession, but it's something to keep an eye on. Since 1948, there's been a total of 11 recessions, averaging out to one about every 6 years. While more common than you might expect, recessions are actually quite short, as they've actually only made up 15% of all months in the last 70 years. In average, since 1950, a recession lasts about 10 months, with the longest one lasting 18 months, which of course was the 2008-2009 chaos, and the shortest, which only lasted 6 months, which was in 2020. The key takeaway is that recessions are commonly quite short. So where are the markets right now? Although we've seen some fairly large layoffs at tech companies lately, unemployment levels are actually still very low, and GDP growth is still positive. However, multiple recession indicators are flashing red, signaling to us that the worst may still be yet to come. So here's 3 indicators to watch for to gauge a recession. Number 1 is the Shiller price to earnings ratio. The Shiller P.E, also known as the CAPE ratio, was invented by behavioral economist Robert Shiller to measure the price of the stock market in relation to its inflation-adjusted earnings. While primarily used as a stock market bubble indicator, the Shiller P.E has averaged a P.E ratio of 16.99 since 1870. In its 150-year history, the Shiller P.E has only exceeded 30 just 3 times, which indicates extreme bubble territory and a potential crash to follow. The 3 instances were the Great Depression of 1929, the dot-com bubble in 1999, and 2021. At the time of filming, the ratio is just a touch above 30, which is, however, fairly average for the last 5 years. Now, number 2 is the inverted yield curve. This is when long-term interest rates actually sink below short-term rates, indicating that investors are actually moving away from short-term bonds and into long-term ones. Historically, an inverted yield curve indicates that markets are becoming more pessimistic about the economy in the near future, as investors investors choose to sacrifice higher rates for greater security and long-term stability. Over the past 50 years, an inverted yield curve has predicted all of the past 7 recessions without fail. And today, that yield curve is in fact inverted. Now, number 3 is the unemployment rate. Usually one of the strongest indicators of a recession, US unemployment actually remains surprisingly low, despite some economic headwinds. After being largely locked down for a couple of years, labor demand remains relatively stable, given that the economy is actually still trying to catch up, although there have been major layoffs recently, and very likely more to come. Overall, the US labor market remains quite resilient for now. So let's keep our eyes on this one. Okay, so now let's get right to it. How do you invest during a recession? Look, if you've got the stomach for it, start scrounging together whatever money you can and get ready to put it to work. I'm going to give you 4 things that the Edge team looks for when investing in a recession. Okay, number 1 is so simple. Stick within your circle of competence. If you don't understand it, don't buy it. It's as simple as that. It's so easy to get swept up into trending industries and stocks that you just don't really understand, even though they're shiny and exciting. But by choosing to invest in businesses you truly understand well, you'll be much better positioned to tell and make the assessment if that stock is trading below what it should be. To find businesses you understand, just look at things in your everyday life. It could be a business that you're a customer of, maybe it's a company you used to work for, maybe you're just really fascinated by a particular industry, like I have been with, blockchain and now more recently artificial intelligence. No matter what your reason for investing in a stock is, always take time to better understand it. And definitely be comfortable saying no if you ever feel unclear on a company. Fair enough? Well, that's just number 1. Number 2, buy fundamentally great businesses. Shift your attention towards the fundamentals of a business and focus on those that have a durable competitive advantage within the respective market. Consider things like a business's brand strength like Apple, cost structure like Walmart, network effects like Meta, proprietary data like Amazon, or anything else that creates a strong, lasting competitive advantage. Those are not stock recommendations, by the way, they're examples of competitive advantages. So investigate the company's financial statements and determine whether this is a business that you feel is capable of growing its top and bottom lines during a recessionary environment. Given the fact that interest rates are rising quickly, I generally give bonus points to companies that don't have debt on their balance sheets, or perhaps minimal debt. A company with healthy and predictable financial statements and a clear business model is usually a strong sign they're capable of withstanding headwinds caused by a recession. Number 3, bet on the jockey. You've probably heard this a million times. It's a very common expression, but it is for a reason. Investing in companies where the management team is closely aligned with its shareholders is an absolute must during a recession. Because at the end of the day, we're all looking out for ourselves. You want management teams that own a significant stake in the companies they represent. This way, they'll be motivated to make decisions that are going to affect all shareholders, not just themselves. You also want a CEO that's comfortable making tough decisions, like cutting costs, laying off employees whenever it's needed. When it comes to making tough decisions, I always take my hat off to those CEOs who even cut their own salary in times of trouble. Finally, and arguably most important, number 4, buy stocks with a margin of safety. You want to buy businesses when they're trading at a discount to their intrinsic value. And that's what we're seeing a lot of right now. Typically, the stock market's the only place where shoppers happily buy at a premium, and when it's at a discount, they're nowhere to be found. But don't let that be you. You need to flip that on its head. You want to find businesses that are cheap without sacrificing the quality of the business itself. And during a recession is the exact perfect time to do that. To find undervalued stocks during a recession, one measure is to look at the company's average historical price to earnings and compare it to both its current ratio and the other players within the industry. If a wonderful business has a price to earnings ratio below that of its peers and its historical ratio, this may be a great sign that the business is undervalued. I often find that when stocks are coming under pressure, you look at the smaller companies, they often get hit a lot harder than the larger ones, and you'll see these massive discrepancy in quality companies trading at a significant discount compared to their larger peers. However, not all small caps or penny stocks have earnings like net profit, so a price to earnings ratio might not be the best ratio to look for. In these cases, look for things like price to sales or even price to cash on the balance sheet. That's one of my favorites. All in all, investing in a recession, though nerve-wracking at times, is one of the most important wealth-building moments of your life. In fact, some of the biggest, most well-known companies that you would have loved 2 years ago are trading significantly down in spite of minimal deterioration in the actual quality of the business. And we actually made a video all about why exactly growth stocks are down. I'll link that, so make sure you check it out. And there you have it. So guys, if you enjoyed this video, give it a like, subscribe, and we'll see you again next time.